Okay, in the second half of this chapter, again, we're going to talk a little bit more about risk itself and how we ultimately understand it, use it, etc. So let's go ahead and move on. Okay, just a little bit of a review. The total risk of a company is a combination of its systematic and unsystematic risk. Other ways to talk about this is market risk and company-specific risk, non-diversifiable and diversifiable risk. The causes here, interest rates, inflation, are causes of systematic risk. Strikes and lawsuits are causes of the company-specific risk. And this is really where I kind of want to show how diversification ultimately works. The W's are the weights, the proportions, if you remember. The variance, this is the variance. So each one of these represents the risk that asset A and B proportionally bring to the portfolio. So that doesn't change. But what does change then is this piece here, which is the impact from the interaction between the two. And these are all square roots of these numbers up here. So these are all positive numbers, except for correlation. Correlation could be a maximum of 1.0. If it's 1.0, then this interaction, this impact, is as big as it can possibly get. So we have maximum risk. But if the correlation was 0.75, then this piece is obviously smaller. What would happen if the correlation went to 0? Then this piece now is gone totally, and we're just left with the risk of the two assets in proportion to each other. And of course, if correlation became negative, then we would then start subtracting from this. So it's possible with a -1 correlation that this impact could be great enough to be as large as these two things summed together. So we could get 0 risk if two assets could have -1 correlation. Again, +1, -1, they don't exist, so we don't have to worry about those more theoretical issues, but it is an issue we have to think about. So again, diversification can reduce risk without reducing the equivalent counter reduction in expected returns. It reduces variability, and it's caused by the offset of worse than expected returns from one asset, that's our company-specific stuff, by better than expected reserves from another. So we have the outliers. Statistically speaking, we have outliers that offset each other. So the minimum level of risk that cannot be diversified away then is this systematic portion, the systematic risk, the market risk. There was a study done that looked at what happens when you add portfolio assets to a portfolio. And they started off and they used the New York Stock Exchange, and they said, look, at the average one stock in the New York Stock Exchange has a risk of 49.2%. Now, what happens if we add one more portfolio to it, or one more asset to the portfolio? What you can see is, as we add more and more securities, the total risk goes down. The market risk, this piece here, the blue risk, the non-diversifiable stuff, doesn't go down. It's the pink stuff here. That's the diversifiable stuff. And eventually, the risk gets so low that adding additional stocks doesn't dramatically increase the diversification that you get. So again, what does this tell us? More stocks are added, right? You ultimately get lower and lower risk as you add stocks together. So if you're forming well-diversified portfolios, you can get rid of about half of the risk of owning a single stock. And it's very important, especially since some people decide that they want to invest on their own. They need to know that they need to have a fairly large set of assets in order to properly diversify themselves. So the systematic risk principle, there is reward for bearing risk. There is no reward for bearing risk unnecessarily. The unnecessary risk is the company-specific risk. So the expected return on assets depends only on that asset's market risk. And again, a statement we had earlier, the only relevant risk is market risk. The contribution of a security to the overall riskiness of a portfolio, we want to know something about its market risk. It's relevant for stocks that are obviously held in well-diversified portfolios. We want to bring them into the fold. What we need, though, and we haven't talked about this yet, is we need a measurement of this kind of risk, because we've only been talking about total risk. So what this is leading us to is saying, look, there is a measurement of market risk that's called beta. It measures the stock's volatility relative to the stock market. So let's say this again. Beta is a relative measure of non-diversifiable risk. It's an index of the degree of a movement of the asset's return when the market return changes. So the asset's historical returns are used to find these. And the beta coefficient for the entire market, or for the stock market in general, is said to be 1.0. The market return is the return on the market portfolio of all traded securities. So again, we don't think about this. Beta measures risk, measures market risk. It's the only important risk when you're talking about portfolios. So what does beta mean? If you have a beta equal to 1, we say the stock has average risk, the same risk as the stock market. If beta is greater than 1, it has riskier than average. It's riskier than average. Less than 1, less risky. Most stocks have betas in the range of around 0.5 to 1.5. Again, the beta of the marketplace is 1.0. The beta of a treasury bill is 0. So here we have a graph that shows some, I don't know how that happened. But here we have some selected companies and their betas. And as you look down through here, we can find that some are relatively low and some are relatively high. Walmart has a beta of 0.42. Nike's 0.78. Ford Motor 1.56. Xerox 1.86. Again, remember, these are measurements of the market risk of those companies. So the beta of a portfolio then is very similar to the return of a portfolio. It's the weighted average. The weights are how much money is invested in each one, multiplied by the beta of the asset. So, again, let's take a second, take what we refer to here as a quick quiz, and make sure we understand where we're going with this. Security C has a standard deviation of 20%, and K has a 30% standard deviation. Since standard deviation measures total risk, security K has the highest total risk. Beta is 1.25 for C, 0.95 for K. So when it talks about here, which security has more systematic risk, security C has higher systematic risk. So the question we have then, which security should have the higher expected return? Remember that standard deviation includes both risks, both systematic and unsystematic risk. So the one with the highest expected return should be, security C. And I don't know if that sinks in right now, but hopefully by the time we're done with the course, that starts to become a little bit more embedded in your mind. So now we need to talk about the risk premium. That's the difference between the return on the asset and the risk-free rate. Well, if beta is tied to returns, the higher the beta, the higher the risk premium should be. So is there a way that we can define this relationship? Is there a way we can connect these two items? And of course, we wouldn't be talking about it if we couldn't connect them. So there is something called the security market line. It is an equation that illustrates the relationship between the returns on assets and betas. And we'll come back to the formula here in a second, but I just wanted us to concentrate on the line for a second. Basically, this theory, this line that comes from what's referred to as the capital asset pricing model, creates this line that says that there is a straight line relationship between beta and the rate of return on the stock. So now we can use this formula to forecast what we think returns of stocks should be. So let's start. The risk to reward ratio, or reward risk ratio, is the risk premium divided by beta. This actually is the slope of that line from the previous graph. In equilibrium, this ratio should be the same for all assets. So what that means is all assets should be on that straight line. What happens if they're not on the straight line? If they're not on the straight line, one of two things is true. One, the capital asset pricing model in the security market line formula is either incorrect, it doesn't correctly illustrate risk and return, or maybe something has changed in the model that has moved the line. Or, and this is the way we typically use it, we assume that the stocks have been mispriced. So that gives us now some opportunities to think about buying or selling assets. So the formula we use, the risk-free rate of return, plus, here's the risk premium, return on the stock market minus the risk-free rate, multiplied by the beta of the asset. Again, it's a very simple formula that talks about the relationship between risk and return. Remember, beta is systematic risk. So the capital asset pricing model is very easy to know. You can find beta almost anywhere. So let's look at some stocks. Here we have the expected returns, 14 and 10 for A and B. The beta is 1.3 and 8. They give us some information for market return and risk-free rate. They now then give us the required returns. So A gives us a return of 14%, but we really want 13.4%. We want 13.4 is going to give us 14, so A is undervalued. We would think that for some reason this stock price is a little bit too low. We may want to think about buying this. For B, the return you think you're going to get is 10%, but you require 11%. So for some reason this stock is overpriced. Essentially what we're talking about is asset A would be above the line, asset B would be below the line. So again, let's think about the factors that affect required return. Certainly the economy, the pure time value of money, that's the risk-free rate. The risk premium, the returns that we see historically on the stock market, those obviously have an impact. And beta, that's the measure of systematic risk of the individual company. So the final step we want to talk about is how do we then move to a portfolio? Here we have two portfolios, V and W. Here's the proportions, the W's, the amounts that are invested in each asset. And here are the betas, right? We can now incorporate them into a spreadsheet. So if we go to a spreadsheet, this is called the portfolio beta and return spreadsheet. You can do this individually for one asset at a time. You put in the weights. It calculates the weights for you then. And then we also input the betas. So for that first beta, for the V, right, we would have a beta of 1.195. For the second one, for portfolio W, it would be 0.91. So again, how can we use this now? On that same spreadsheet, you can plug in some information. I put in some recent kinds of numbers. The risk-free rate's 3.9%. And we know from the previous chapter, the market risk premium is around 5.4%. Beta is 1.16. So for a case of S, so the expected return, for V, we would expect to get 10.35%. And for W, we would expect to get 8.81%. Again, we're calculating what we think we're going to receive if we invest in these assets. Can we do this without the market risk premium? Well, all we need to do now is we need to have some estimate of what the stock market's going to return. If you remember from the previous chapter, large stocks average in the ballpark of around 11.7%. So I just chose 11% for the average rate of return in the stock market. And of course, you can choose anything between 10 and 12. You're probably in pretty good shape with that return. So for this, again, particular company, right, we would end up having a expected return of 13.3%. What happens if the stock market changes? If the stock market goes up by 15% and you have a company with a beta of 1.5, you would have an increase in expected return of 22.5%. If you only had a beta of 0.25, your stock would follow the stock market, but it would only go up by 3.75. So you can see beta is a measurement of volatility. It talks about how responsive the stock is to changes in the stock market. So again, just to kind of repeat again, security market line comes from the capital asset pricing model. It reflects the required return based on the risk level of the company. So we have, again, this graph. It's the security market line. Here's the risk-free return. The difference, beta equal to 1, tells us where the stock market return is, 11% in this case. That tells us that this piece is what's called the market risk premium. But the company has a beta of 1.5, so this line, which also includes this market risk, is the asset's risk premium. Now, what happens over time? Inflation can change. When inflation changes, things happen to the security market line curve. If inflation shifts, the curve or the line shifts upward in a parallel fashion. If investors become more risky, right? We've had a recent downturn in the market. I saw something the other day that said only something about 28% of all investors are invested in the stock market. That's crazy. We're just going through a boom stock market, and everybody has missed the boat. Well, what happens is people have become more risky, and their security market line has shifted upward, but it hasn't shifted, it's rotated. So now the security market line is a much steeper slope. So what does this ultimately mean? The capital asset market line relies on historical data. Betas may or not actually reflect future variability. Therefore, we know these required returns are rough estimations. The capital asset pricing model assumes that stock markets are efficient. Stock markets are not strictly efficient. They have some issues with respect to prices, how prices change, etc. But in general, the capital asset pricing model is the best model we have now for understanding and illustrating the relationship between risk and return.